Tuesday, May 11th, 2022, Monaco 64, home of alternative economics and contrarian views. So today we're going to look at how the Fed is already warning investors, market participants, the whole world, that its policy of increasing rates, of unwinding its balance sheet, is already causing loads of problems in the markets in terms of liquidity and the depth of the market. And it's warning as well that its own policy is posing a risk to the economy. Could they be setting us up for a reversal? I don't know, but we're going to go through an FT article that came out yesterday. This was published in a report by the Fed yesterday. They do this kind of risk assessment twice a year, I think in May and November. And before we look at the markets today, we're going to go through some year-to-date numbers of all asset classes, currencies, gold, silver, to put things into perspective and to see which asset really has been a good safe haven in 2022. Seeing that 2022, the start to this year, has been one of the worst starts for not just stocks, but also bonds. So, yeah, this came out yesterday in the FT, this article. Fed warns sharp rise in interest rates poses risk to U.S. economy. U.S. Central Bank warns of negative feedback loop if market liquidity deteriorates. It's interesting that Rafi Farber touched upon liquidity, a liquidity crunch, late last week, and I had him on my live stream to talk about just that on Sunday. And it's interesting that the Fed published this yesterday. So we're going to go through this article. If you don't know what liquidity and market depth really means, this article will explain it. So this is by Colby Smith in Washington, D.C. and Eric Platt in New York. A sharp increase in interest rates to tame fresh inflation shocks would pose a risk to the American economy, the Federal Reserve said on Monday, as it reported a higher than normal chance that trading conditions in U.S. financial markets will suddenly deteriorate. And this is from the report. Further adverse surprises in inflation and interest rates, particularly if accompanied by a decline in the economic activity, could negatively affect the financial system. Policymakers wrote in the Fed's Financial Stability Report, which is published twice a year in May and November. Consumer finances might be hit by job losses, higher interest rates, and lower house prices. The Fed cautioned, with businesses also facing higher delinquencies, bankruptcies, and other forms of financial distress. Well, I think this is already starting. I think the Fed is just covering its backside with this. You can bet this is starting to happen already, I would say. A sharp rise in interest rates could lead to higher volatility, stresses to market liquidity, and a large correction in prices of risky assets, potentially causing losses at a range of financial intermediaries, the Fed reported. That would reduce their ability to raise capital and retain the confidence of their counterparties, the central bank added. And in terms of this raising capital, there's an article yesterday. It looks like it's starting to happen already. Came out on Zero Hedge. Stock market panic spreads to credit. Goldman Sachs halts CMBS deal due to surging market volatility. And I was speaking to a few of my friends that I keep in touch from the city. One of them actually ran a hedge fund during the '08 crisis and did very well from it. And he was telling me yesterday morning that this could become a problem, that the Fed is really focusing on credit. Credit for them is everything. So let's continue. The US also issued a warning about liquidity, the ability to buy or sell an asset without influencing the price. Following several frenzied months in US markets, a sell-off has wiped trillions of dollars off the value of stocks and bonds while closing the door on new share listings and raising borrowing costs for consumers and corporations. So here we come to the liquidity part. They go through what it means. The Fed said the ability to buy or sell assets at prices quoted by broker-dealers had deteriorated and was worse than should be expected given the levels of volatility. It added that the decline in liquidity might be compounded by brokers and high-frequency trading firms being particularly cautious given the market conditions. So yeah, if you're a big financial institution like a mutual fund or a hedge fund or an insurance company or Berkshire Hathaway, you call a broker dealer to get a price on like something, a trade that's worth $2 billion, for example, certain security, and you ask them for a quote. You don't tell them what you're going to do, buy or sell. You ask them for a bid and offer quote. And when the markets are normal, let's say, they will quote 102.5 at 102.55, 102.50 to sell, 102.55 to buy. But what this means, what the Fed is saying, that right now people are so concerned, the broker dealers, the people who make the market, that they're quoting, let's say, 102 to 103, which is very wide, especially when you're dealing in billions. The broker dealers, they have very tight bid and offer spreads. And this is not surprising because the Fed was warning about this back in 2020 already. In March of 2020, the liquidity was drying up. Guess in what market? The one that's supposed to be the risk-free, most liquid market in the world? Well, treasuries, right? So yeah, things are not doing very well. Declining depth at times of rising uncertainty and volatility could result in the negative feedback loop, as lower liquidity in turn may cause prices to be more volatile, policymakers wrote in the report. Conditions in treasuries, commodities, and equity markets have been noticeably poor this year, with traders reporting that they have struggled to conduct even relatively small trades without influencing prices. The swings in the price of everything from treasuries to corporate bonds and stocks have also been driven in part by the Fed's move to tighten monetary policy, as well as Russia's invasion of Ukraine and the economic slowdown in China. So they're getting a few scapegoats here. Nothing to do with the massive money printing that the Fed engineered and the leverage that it created by providing, while still providing credit and capital at real negative rates, basically for free right now. The central bank last week delivered its first half-point rate rise since 2000 and is set to implement additional increases of the same magnitude at its two next policy meetings. In June, it will also start to shrink its $9 trillion balance sheet, which ballooned after it hoovered up bonds during the coronavirus pandemic. As it steps up its efforts to rein in the highest inflation in roughly 40 years. The prospects of higher interest rates has pushed the yield on the benchmark 10-year treasury to its highest level since 2018. Yeah, in 2018, I think it was up to 3.25 before it went back down. I think yesterday we went up to almost 320 or 316. but we're very close. That rise has forced investors across the globe to reassess the value of many of the stocks they bid up to record highs over the past year, with the S&P 500 stock index down more than 16% this year, and the tech-heavy NASDAQ composite declining more than 25%. The Fed also flagged potential risks associated with a prolonged war between Russia and Ukraine, which has already put strain on commodity markets. Russia's unprovoked war in Ukraine has sparked large price movements and margin calls in commodity markets and highlighted a potential channel through which large financial institutions could be exposed to contagion. Leo Brainard, the vice chairwoman of the Federal Reserve Board, said in a statement alongside the report on Monday. The Federal Reserve is working with domestic and international regulators to better understand the exposures of commodity market participants and their linkages with the core financial system. So what do I think the Fed is trying to warn us against? Well, of course, about liquidity, volatility, but it looks like it's the little first little chink in the armor of their supposed hawkishness that we've seen for almost the last 12 months. And why do I say that? Well, because they're saying that current conditions are posing a risk to the economy, and one of their mandates is to maintain economic growth, a strong labor market, full employment. And notice that they didn't mention anything about all the QE they've done and the fact that they've kept rates near zero for over 10 years. Yes, they tried to reverse it in 2018, but they quickly had to back down. And I mean, the fact that they're mentioning the war in Ukraine, that could be a cover. They could use the volatility in commodities as an excuse. So we'll have to see what happens. The markets definitely feel like are trying to telegraph to the Fed that there is a problem. It's almost like they're clamoring for the Fed to stop with this, but we'll have to see. So before we look at the markets then, I told you I wanted to go through some year-to-date numbers because I think it helps put things into perspective, because I would say all asset classes, including gold, silver, the miners, have been hurt quite hard in the last couple of weeks. And there's a lot of talk as well that the dollar has gone up a lot. People are focusing on the dollar index. So this is why I wanted to do this. So I'm going to start actually with money, with currencies, because I think they are at the base of everything. If your currency is no good, none of your financial assets in that particular country are going to do well. So decided to start with sterling year-to-date numbers. So we're going to look at the price of gold, XAU GBP, year-to-date. And I took these prices 7:30 a.m. London. They are not, they might be different now, but I don't think it'll make too much difference. So year-to-date, the price of gold in sterling is up 11.87%. And it's strange because it feels pretty negative, the sentiment for gold, even here in the UK. But I was surprised when I looked at these numbers that the price of gold is actually up almost 12% in terms of sterling. Silver, price of silver in sterling, XAG GBP, is up 4.08%. So now let's look at the major reserve currency, the dollar. So XAU USD is up 2.3% year to date. So gold is up 2.3%, which means that gold is beating the dollar. It's the opposite of the dollar. So whatever the dollar index doesn't really matter because gold is ahead of the dollar. Dollar index measures other fiat currencies that are doing just as bad as the dollar. Dollar is not doing as bad, of course, for example, as the British pound versus gold. XAGUSD, which is silver, that's down 4.7%. Yes, it hasn't been a great store of value, silver, so far year to date. But I would say that it's not all bad when we look at other assets, and we're going to come to that in a minute. So now I've looked at the euro, XAUEUR. While gold is up 9.74%, so almost 10% in terms of euro. Silver in euros is up 2.15%. So it's held up there well versus the euro. And now we come to the Japanese yen, XAUJPY. While gold is up 15.3% versus the yen, and silver is up 6.696, so almost 7%. And I wanted to look at Bitcoin, which many people think will be a replacement for fiat currencies. Year to date, and I took the Bitcoin futures because they settle. Bitcoin price doesn't really, it keeps going 24/7. So year to date, Bitcoin is down 29.26% versus the dollar. So what this is showing me is that gold and silver have been a pretty good store of value in a very rough market and financial condition. I mean, you just saw that the Fed is warning about financial conditions. So gold and silver have held up relatively well, I would say. So they're doing what they're supposed to do, what it says on the tin, right? So now we're going to go to some riskier assets, because currencies are at the bottom of the base, and then you have everything else that evolves from the currency. So start out year to date, TLT, which is basically an ETF for longer term treasuries, average maturity of 20 years. While that's down 20.53% year to date. Just remember that treasuries are supposed to be a safe haven, risk-free asset. The NASDAQ index, 100 index, is down 25.71%. S&P 500 down 16.26%. The Dow is down 11.26%. And interestingly, the CMOD commodity ETF is actually up 24.38% still year to date. And that shows to me that this liquidity crisis that we're seeing is the beginnings of a shift from paper to hard assets. And I think that proves it. Euro stocks with 50, which is the major companies in the Eurozone, is down almost 18%. The FTSE 100 index is down 2.27%. That has held up relatively well, but the currency has dropped a lot, of course, the British pound. The Nikkei is down 9.12% year to date. So now we move to the miners. GDX is up 3.14%, so still up on the year compared to the NASDAQ. That's an outperformance of almost 30%. Yeah, GDXJ, and I've warned people about this, or I've told people that mining is like very speculative. So if you put some of your hard-earned savings into miners, you're not really investing in gold and silver. You're investing in the companies that mine for gold and silver, and that's a riskier proposition. Am I saying that I'm out of the miners? I don't want to know anymore? No, but it's going to be a rough ride, a lot of volatility, and GDXJ now is down 6.46% year to date. But in relative terms, it's actually outperforming all the major indices. And SILJ, junior silver miners. And yes, I admit I have a few of those, and my holdings have been hit hard because of that. But I'm holding on because, and probably adding on to it, because I believe silver is going to join the move to hard assets eventually. But that's why, for me, my holdings of the miners is a percentage of my savings. It's not everything. I haven't put everything into that. I still hold physical gold and silver. I think that's still a very good foundation to try to maintain the value of your savings, and maybe even increase its purchasing power. So yeah, SILJ is down almost 11% year to date. So just a quick conclusion before we look at the markets. The reason why I did this is just to show you that in the really rough waters, and I did a video about this, that we're trying to go around the Cape Horn in South America. That's the route that most shipping vessels used to take before you had the Panama Canal, and it's a very treacherous stretch of water. And I think that's where we are, and you need some gold and silver, and I think these year-to-date numbers prove that. So let's quickly look at where the markets are then this morning. It's 8:28 a.m. London time. We've got spot gold at 1862. That's up $8 or 0.5%. High's been 65. The low has been 1852. Spot silver is up 27 cents or 1.25% at 2206. High's been 2212. Low 2170. Dow futures up 0.8%, 260 points at 32,508. The NASDAQ 100 future is up 193 or 1.6%. And the S&P 500 future is up 40 points or 1%. It's back above 4,000. It closed below 4,000 yesterday. It's at 4,032. FTSE is up 60. The Euro Stoxx 50 is up 50 points. To the currencies, sterling is unchanged, 123.34. Euro unchanged as well, 105.62. The dollar is unchanged versus the yen at 130.32. The dollar is down a third versus the yuan at 673.70. Aussie dollar is unchanged, 69.52. US dollar is up slightly versus the Canadian dollar, 130.17. And the Kiwi dollar is down slightly at 63.22. Quickly look at the general commodities. WTI crude is unchanged, 102.10. Brent crude, 105.25. That's unchanged as well. Yes, crude oil has taken a big hit since we last spoke yesterday. High-grade copper is up 0.2% at 422.50. Natural gas, U.S. nat gas also took a big hit. It dropped 10%. We were above 8 yesterday. Right now, we're unchanged, but we're at 707. And there's the volatility as well in all markets and commodities. That's really not a good sign for the economy, because businesses need to buy these commodities to produce goods and services that they sell to us, the consumer. And if the prices are all over the place, it's not a good thing. It's difficult to plan and price things. And I think it just shows that the currency underlying these commodities, there's trouble in the currency because all commodities are very volatile. It's not like just one commodity that has a particular problem with its supply chain or with harvest and the weather. It's everything. And that tells me that the problem is with the currency. So to finish off, let's quickly look at the 10-year yield. Yes, the big drop in stocks yesterday led people to buy into the 10-year a little bit. Yields dropped from their highs at the beginning of the day, and they're continuing to drop here. But we're still at 3.04% in the 10-year. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.